All right. Hello, everyone, and thank you for joining us today to explore Treasury Notice 2025-42, the new and old beginning of construction rules for solar projects. Today's presenters include myself, Nicole Withrow, Director of Sales for Collective Sun, and my colleague, Lee Barkin, Chief Community Officer at Collective Sun. The information presented today is for educational purposes only and should not be construed as tax or legal advice. You should always consult your tax advisor or legal professional for personalized guidance. Tax law is all about facts and circumstances. So while Lee is a CPA, he is not my CPA. He is not your CPA. As you are likely aware, every rule seems like it has an exception and exceptions to those exceptions, excuse me. So if you're watching this today and you're thinking, oh, that applies to me. You're probably right, but you might not be because there might be an exception. The point in all of this is to say you really want to engage with your own tax advisor or legal professional who can provide guidance tailored to your unique facts and circumstances. And if you're watching this webinar in the web archive later on, please be aware that today's date is September 4th, 2025. As with all things related to tax law and Treasury guidance, you want to be sure you're always referencing the most recent information available. All right, who is Collective Sun? Collective Sun is a solar financing organization that helps solve two basic problems for nonprofits going solar. How do we pay for it? And how do we get it built and built properly? We help solve these problems with financing solutions and with construction management, fund control, and other components to make sure that things get built properly. Since 2011, we have helped hundreds of nonprofits fund solar projects that free up their resources to better serve their communities. We currently have projects in 24 states, totaling over 31 megawatts and more than $84 million in projects. And it's this experience working with nonprofits that has helped us to develop a unique understanding of the financing challenges that they face and the tools to overcome them. And with that, I'm going to hand it over to Lee in a moment and we'll dive into the fun stuff, solar policy, treasury guidance, and rules for beginning of construction. Lee Barkin, I know policy is one of your happy places. Are you ready to wax poetic?
Welcome to my happy place. Yes, thanks for that great introduction, and thank you also to Rosanna, who's been so incredibly helpful generating all the content that everyone's been reading and the emails and articles that have been going out. Thank you again very much for your help. So today's adventure begins with OB3. I'm sure by now you're already familiar with the reconciliation bill that passed on July 4th of this year. And the takeaway is that there are changes a coming, and there are, uh, you know, ITC credits that are going away. And there's an incredible sense of urgency that's come out of this bill for folks who wanted to get their project started right away for reasons we're going to, talk about with beginning of construction. So the headline is ITC is going away and your project has to be placed in service by December 31st, 2027. Or you must begin construction on or before July 4th, and then you have 4 years to actually place it in service. There's also a foreign entity of concern we call the ITC disqualification gauntlet. It's kind of this crazy maze adventure that you go on that could potentially eliminate your eligibility for ITC. That is not what today's presentation is about. We spent an hour talking about FEOC a couple weeks ago, and when you get these slides, you'll see there's a link to that webinar below by clicking on the slide link. But FEOC itself also has a begin construction safe harbor for 12/31/2025. So you see these big bolded items here, begin construction, begin construction. What is begin construction? We should talk about this because now it matters a lot for meeting these safe harbor requirements. So a couple days after the bill was released, there was an executive order, and you can follow the hyperlink to read the executive order here. But the executive order was basically trumpet noise, and I say that because you don't need an executive order for Treasury to issue guidance. Treasury can do that anytime. Treasury can do that today if it wanted to and say, here's new guidance. Or it can say, hey, that guidance I issued on August 15th, that's no longer valid. It can do what it likes. The trumpet noise was fairly performative, but if you read the statement, it was all about directing Treasury to restrict the broad use of all of these safe harbors. And we were in a period of ambiguity for a couple weeks. Thankfully, that ambiguity is now gone, and we have some clarity. But for a while, we were all kind of wondering what's going to happen to this body of knowledge, these historical rules, I'll call them. We have 16 years worth of historical precedent, notices. The whole industry has kind of figured out what does it mean to begin construction for a solar, wind, or other kind of project. And there's all these notices. I've bolded the two kind of important ones in 2013 and 2018. If you want to dig into them, that's where I'd start looking. But functionally, there's two different safe harbors. There's a physical work test, and there's a 5% safe harbor based on 5% paid or incurred on spending. Let's just touch on those now, and then we're going to dive deeper into them. So the physical work test is all about physical work of a significant nature. Like the name sounds, it's doing the work. It's not about how much work is done or how much it costs, but it's just performance of the actual work that has to be, quote, significant. So what is significant work? Well, it's building things. It's making those transformers or wind turbines, installing physical structures and pouring concrete and mounting things. It's turning wrenches and using shovels. It is physical work. Preliminary activities do not count under these historical rules. All the planning, admin, legal, getting permits, uh, purchasing equipment, unless it's custom equipment. Because if it's custom equipment like transformers or wind turbines, it can fall into this definition. But generally, when we talk about buying solar panels and inverters and things like that, that is not going to count for physical work. It'll count for the other test. Uh, but purchasing equipment will fall under preliminary activities, and we'll dive into that a little more detail a little later. Site prep, just like getting the site ready for this project, is a preliminary activity. That is not considered physical work. So we'll dive into more details, but just at a high level, think physical work of a significant nature, actually doing stuff. Whereas the 5% test is all about paying or incurring costs. And I use the terms carefully: paying if you're on the cash basis, or incurring if you're on an accrual basis. And if you don't know what the difference between those two are, then have a conversation with your CFO or your treasurer and make sure you know which, sort of category you fall under. Paying an expense is all about when the physical dollar moves. Incurring an expense is all about when you give rise and accrue a liability. There is a deep body of knowledge and work all around what does it mean to record a liability. That's beyond just solar and 5%. It's for all liabilities on your balance sheet under GAAP. So check out section 461 if you want to dive into that. It's the all events test. I would call your attention to the economic performance component, because economic performance means that you have to have performance. The services or goods have to be performed or received. Like something actually has to be completed, and not just like make a deposit. Making a deposit does not meet the economic performance test. Delivering a module meets the economic performance test in most cases. Back to the facts and circumstances, your mileage may vary, but generally speaking, we are talking about completing a service or delivering a material. That's going to meet the economic performance test. There are some exceptions. So there's the 3.5 month rule. You can pay for this, and then if you reasonably expect it's going to be delivered in 3.5 months, you can be deemed to have met that economic performance. There's also a look-through rule, which we don't get into too much on the 5% test. It doesn't affect us quite as much, but there are some situations like in large utility scale projects where you can meet economic performance by looking through to the manufacturer and the work that they're performing. So just be aware there's a couple of exceptions to take note of, but the high level bullet points are that only eligible ITC costs count. So if you are trying to meet this 5% pay or incur by spending on things that are not ITC eligible, you're going to miss it. So it has to be only ITC eligible costs. And we would encourage you to not go for the minimum 5%. Please go for a bigger number, 7 to 10%. Some people are doing 12%. And the reason is because it's based on the amount at the end of the project, not the amount you think it's going to cost when you start the project. So if you begin construction today and you think your project's going to cost $100,000, so you pay or incur 5%, if there is a change order, if things happen, these are construction projects, it's rare, but you can have situations where there's a valid change order and that project cost could increase. If that project cost increased to $101,000, now that $5,000 you spent is 4.95% and you've blown your safe harbor. So you really want to anticipate potential increases in cost by making sure you're paying or incurring at least 7 to 10% of the cost, just to give yourself some safety margin in there. There's some other kind of quick bullet points, which we'll get into more later. It's got to be a binding written contract. There's some rules around what that means. There's a continuity test. So you have to meet one of these two safe harbors, either physical work or 5%, and have continuous construction in the continuity test, which we'll talk about in a little bit. Facts and circumstances are everything in these situations because there's a lot of gray area in the rules. But if you can stay on top of record keeping and documentation, keep all of your, write up memos for the file, keep copies of invoices, take photographs, like all of those things are going to strengthen your position and strengthen in gray area. You want a really strong case, uh, to protect the integrity of your safe harbor. So that was the history, right? We had this sort of body of 16 years of notices, and there was two different pathways. You could go down the physical work and go down 5%. And then notice 2025-42 came out. And this was in response to the executive order. And in 2025-42, the first thing they did was they recognized that this is in response to the EO, and they said, we wanted to make sure that there wasn't, we're preventing artificial manipulation of eligibility, which is good. Nobody wants, manipulation of any of these rules. They want clarity to understand the rules and be able to build projects that are in compliance. But they went out of their way to like tip a hat to that EO and say, we're being responsive to this EO. And we've determined that this meets that bar. That based on these rules, this properly enforces the credit termination date for wind and solar facilities. It's important to remember that the entire notice, all of this, conversation about what's going to change, it only had to do with solar and wind projects with respect to whether or not they could claim beginning of construction on or before July 4th. That's it. That's all that these like new rules apply to. They don't sort of creep out beyond that. They don't apply to other kinds of technologies. They don't apply to other kind of safe harbors. They really just apply to this narrow question. Did I begin construction for purposes of the ITC safe harbor on or before July 4th, 2026? And I'd also note that it wasn't retroactive. It wasn't even effective on the day of the notice on August 15th. They even gave us a couple weeks. And they said, oh, okay, this becomes effective September 2nd. So, as Nicole mentioned, it is September 4th. So you missed your chance if you were trying to, get under the prior rules. But as we'll explain a little bit, it actually probably isn't going to matter. These rules ended up being very, very minor in their application for the kinds of projects for the folks on this call. For nonprofits who are building a solar project on their roof or in their parking lot, small, medium, commercial scale projects, nothing really changed. There was it's kind of a whimper. There was not a big uh, drastic change in the rules from the historical, but I'll walk through like all of those details so that you can get a really good grasp on it and be confident kind of going forward with how this is going to work. I would encourage you to read the notice. I put the hyperlink in here. It's 20 pages. It's not that bad. I actually think Treasury did a great job. It's well written. It's clear, understandable. Sometimes some of the guidance gets a little bit esoteric, but I actually thought this one was pretty approachable. So please do take a moment to follow the link and check out the guidance itself. It had nothing to do with foreign entity of concern. In fact, FEOC was mentioned one time, and here's the snippet. It was a footnote, and all it said was, this does not apply to FEOC. That was it. This is only for ITC eligibility for beginning of construction for July 4th, 2026. And part of that is because here's a snippet from OB3 itself. OB3 codified that the definition of beginning of construction for the purposes of FEOC was codified this way, the historical rules. So they made some changes to the way beginning of construction is applied to the ITC eligibility, but the FEOC rules they left under the historical. So time out. There's a fork in the road. We literally have one bill that has two different definitions for beginning of construction, and they apply to different things differently. So today's conversation is only about Notice 2025-42 and what it means to begin construction for the purposes of ITC eligibility. But you can rest assured that everything in these historical rules, if you can meet one, you're going to meet the other. So you're going to be fine. But there are some edge cases where this does matter a lot, and you're going to want to pay attention to your facts and circumstances. But it's mostly going to be for large scale projects, particularly over 1.5 megawatts are going to have issues. If you're building, a smaller project on your roof and in your canopy structure, um, there's less concern that you're going to have. These are going to be way more approachable and easier to understand and easier to execute on. So here's some snippets from the notice itself. It kind of reaffirms, most of this notice is reaffirming things that are already in the historical rules. So they talked about how there's no fixed minimum amount of work. There's no fixed dollar amount for the physical work test that we're talking about now, just the physical work test branch. Both offsite work and onsite work are going to continue being respected. There's this comment about binding written contract. Um, and it has to be physical work of a significant nature. So again, here in English, no changes for physical work. No significant changes for these kinds of projects. It's all facts and circumstances based. It's still physical work of a significant nature. It's the nature of the work, not the amount or the cost of the work. And you can still do some stuff offsite. For example, if you are constructing transformers or wind nacelles offsite, you can claim that my physical work has begun, even though it's not on the premise itself. So all these rules are the old rules basically being reapplied, saying, okay, we're good. Like no changes there. Uh, I mentioned a second ago about offsite work is allowed. The only comment I'd make here is this is really only helpful for large utility scale projects that are ordering custom equipment. So they're ordering transformers, they're ordering wind nacelles, where that individual, manufactured product is going to go specifically for this project and be delivered at some point in time. The only kind of maybe edge case here, if you're a nonprofit, is if you are constructing a canopy structure, a parking lot structure, a steel structure, and you are custom fabricating that, you may be able to make a claim that a support structure gives you a toehold into the physical work test. But as you hear these rules, you'll start noticing a theme, and that is the physical work test is really more useful, and historically where we've seen it applied is really for large utility scale projects. So the stuff we're working on together, those are almost certainly going to use 5% test. And historically, they've always used 5% test. Uh, and so not a whole lot has changed with these new rules, I guess is my point. So under the physical work test, physical work does not include manufacturing for things that are normally held in inventory. So if you order some solar panels and some inverters, that's not really getting you a toehold for the physical work test. It will get you some benefit on the 5% test, which we'll talk about. But if you're just looking at the physical work test, if it's something that's normally held in inventory, like that's just not going to count.
Lee,
Um,
would you say that's kind of like whether something comes off an assembly line versus something custom made.
That's exactly it, Nicole. It's really, you honed in on the correct word, custom made. So have you ever seen a custom made solar panel?
I have not.
Like what it would be a stretch. And I do not believe these facts and circumstances have ever been tested. Maybe they have, I'm not aware of, but you could have an edge case like your Coca-Cola and you order custom fabricated solar panels all with Coca-Cola red frames. And like
Yeah,
maybe you can make that claim that that was custom fabricated. Like you can start getting into these really strong edge cases. Um, that kind of comes back to our motto of just like, don't play games with the IRS. Like, just don't. Like, but if you want to get philosophical and talk about bizarre edge cases, like, okay, in theory, that's how the facts and circumstances would be tested, and I don't know how it would ultimately be adjudicated, but um, for folks on this call, if you're just ordering modules and inverters, yeah, that's not custom made for you. The only exception there is you might be building a canopy structure and doing custom steel. You might be doing a custom parking lot canopy structure, and maybe there's some toe hold conversation there. But again, I don't think you're gonna have to worry about this. I think we're gonna qualify under the 5% test, which we'll talk about in a second. Um, on the physical work test, still on-site physical work is what you think it would be, and they spell it out here, I think, cleanly and nicely. It's like installation of racks and affixing PV panels to structures. Like that is turning wrenches, climbing ladders, affixing things, digging holes. Like it is very clear you know what on-site work looks like. um and it's just that when we're talking about distributed generation projects, these sorts of things normally happen later in the process. So you're going to get a better beginning of construction date with a 5% test in most cases. Your circumstances may vary. But they also are very clear about, what is a preliminary activity. Again, something that is not physical work is a preliminary activity. And these things don't count. So if we're just talking about planning and designing and securing financing and researching and getting permits and licenses, that takes a lot of time on our projects. Those things are preliminary activities. Clearing a site, that's a preliminary activity. That does not count as physical work of a significant nature. The last one on here, we just got this question a couple weeks ago about I'm removing the air conditioning from my roof.
and
That's part of site prep. So removing existing foundations, solar panels, that is not physical work under this definition. That's just a preliminary activity. So you got to bucket the activities in one of those two things. Um, but I mean, it's basically moving dirt, right?
right, turning wrenches, digging in the dirt, but only for things that are not related to preparing the site.
Yes, and that's where all this kind of gray area comes in. Like I call your attention to if you're excavating to change the contour of the land, that's sort of like grading. That's a preliminary activity. But if you're digging straight down to excavate for a foundation, that's physical work of a significant nature. So you see how it depends how you dig in the dirt.
Right.
Like it gets into like really nitty gritty facts and circumstances, but this is I find this very helpful to have these sorts of examples provided to us. So let's shift gears now. That is all physical work test, probably more applicable to larger scale utility projects, wind projects, other, large solar projects. But now we're shifting gears into the 5% safe harbor. This is all about paying or incurring 5% of the project cost. The project costs at the end of the project, only ITC eligible costs. So the banner here, the headline was like 5% is eliminated. So Treasury, is being responsible. We're getting rid of all those pesky loopholes and we're tightening this up for beginning of construction that, the 5% test is gone. And then you read this little except for section 6. So okay, what is section 6? Well, section 6 creates this new definition for a small solar facility. And I'll note this is only solar. Wind did not get this exception. 5% test is gone for wind. Uh, but for solar, if you're at or under 1.5 megawatts AC, I want to be really clear, it's not the DC number, it's the AC number. So you have a little more wiggle room. If you're 1.5 megawatts or under on solar, you can continue using either the physical work test or the 5% safe harbor. You have a choice. So functionally, that's basically saying there's no changes for projects under at or under 1.5 megawatts AC. You can keep using the same ones that you used before. So that's great. So let's make sure we understand how to do all those. But first, there's been a bunch of questions, and just in the last couple of weeks, I feel like there's been a half dozen calls fielded about how does this 1.5 megawatt work with aggregation, what they call integrated operations. So I'm on one physical site, but I have three different sort of solar systems. And if they total more than 1.5 megawatts, have I blown this exemption? Am I no longer eligible for 5% safe harbor? So this notice gave us very clear guidance on how to determine if there are integrated operations just for this 1.5 megawatt maximum rule. So pause this for a second and back up to the historical rules. The historical rules had a whole body of knowledge around functional interdependence to determine how many qualified facilities do I have. So I have a field with 100 wind turbines in it. Do I have one ITC or do I have 100 ITC? And there were a lot of like rules, and they followed kind of engineering doctrines about functional interdependence. If I have this component, does it need that component? And together they make electricity. So in the simplest terms, if I have a solar panel and I have an inverter, they're functionally interdependent. You need both of them in order to generate that electricity. So you would say that that's like one energy facility. Okay, well, what if you had a site that a roof had a roof over here that had its own PV modules and its own inverter, and then over there you had a site with its own PV modules and its own inverters? You would get into these facts and circumstances tests about whether or not that they were functionally interdependent, whether you needed one for the other to work, and whether or not that qualifies as one ITC or two separate ITC. So there's a lot of body of knowledge around determining how many ITCs are there. This is different. So this is a rule just about figuring out whether or not you are eligible for the safe 5% safe harbor by staying under 1.5 megawatts. And unlike the functional integration tests, which have like 7 different factors, they're very subjective and there's a whole analysis that goes into it. These are nice. These are clear. They give you 3 things. They say, like, if you're owned by the same taxpayer or related taxpayer, like same taxpayer, same taxable year, and same point of interconnection, then you're integrated operations. So if you can check the box on all 3 of those, then you're integrated. So if you have 3 different sort of arrays and they're all owned by the same taxpayer, they're all placed in service in the same year, and they all go into the same point of interconnection, you could potentially, if they add up to more than 1.5 megawatts AC, you could blow this exemption. Even though under the old rules, you might be able to make an argument why those are separate energy properties, separate qualified facilities. These don't necessarily automatically tie. There's 2 different analyses that you have to do. So when you're trying to figure out, am I going to be eligible for the 5% safe harbor, just go back to this definition on the slide and ask yourself, do I have integrated operations that exceed 1.5 megawatts? And in practical terms, that's probably going to come down to a question of your point of interconnection, item C on this list, because you're probably the same taxpayer. More than likely, you're going to be placed in service in the same taxable year because we're all trying to get our projects done before 12/31/2025. So it's really going to come down to your point of interconnection, where you transcend from customer-owned equipment to utility-owned equipment, and you're going to have an interconnection agreement, and you're going to have to pull that information from that interconnection agreement to do a really thoughtful kind of analysis. So we've seen this already tripping up projects, and you want to pay attention to make sure that your 5% safe harbor, the integrity of that safe harbor is protected by ensuring that you do not trigger this integrated operations definition for your particular project. Okay, we've talked about physical work. We've talked about 5% safe harbor. You're going to go down one of those pathways. In addition, there's also a continuity requirement. Now, before this notice, there were two different, one was called continuous construction, the other is called continuous efforts. Those are gone. Now we just have something called continuous program of construction. You have to meet one of those two items and one of those two pathways, and you have to be in a continuous program of construction. So what is a continuous program of construction? They tell us, but it's not super helpful. It's just continuing physical work of a significant nature. So it's not like very clear cut, and there's a lot of facts and circumstances that are going to come into play. But they do give us a list of things that are, kind of get out of jail free cards. Like, look, if there's severe weather, if there's natural disasters, if you have difficulty obtaining your permits or licenses, if there's interconnection delays, like this is our greatest hits, right, Nicole? Like all the things that go wrong on projects. But the theme that ties all these together to me is they're uncontrollable. Like you cannot control a supply shortage. You can't control a natural disaster. So what they're saying is, we have this continuity requirement, but we're going to give you some grace for certain things that are out of your control. But there's still a ton of gray area in all of this. So they gave us a safe harbor, the continuity safe harbor. It's a safe harbor inside of a safe harbor. And so what they're saying is like, look, if you place this system, if you place it in service, if you take this project, you place it in service, by the end of the fourth year that you started, then we're going to deem it as having met the continuity requirement, and you don't have to mess with all of these facts and circumstances and prove to us there wasn't a natural disaster and all these other items. So let's say that math one more time. If you start construction today, September 4th, 2025, if you place it in service before December 31st, 2029, that's a little more than 4 years. That's why in our slides and our conversations, sometimes you'll hear us say 4+ years, because there are some circumstances, it can work out to slightly more than 4 years. You have the this window that you will be deemed to be eligible and have met the continuity requirements. So if you don't place it in service by the end of the fourth calendar year, then you have to go back to the relevant facts and circumstances, and then you have to actually go back and prove it. That does give you a little bit of an extra shot on goal, like if it does end up taking 5 years, but trust me, you don't want to go there. You really want to do everything possible to rely on this continuity safe harbor and get it placed in service by the end of the fourth calendar year in which you start construction.
Lee, that continuity safe harbor that applies to both pathways for begin construction?
Exactly. Yeah,
Cool.
regardless of whether or not you choose the physical work test or the 5% safe harbor completed in that 4 year window. Um, very, very, very important. So I guess, that sort of takes us back to the beginning, which is, why does all this matter? Well, we started off saying there's these new safe harbors, and they're based on beginning of construction. So if you want a safe harbor and get that 4 year safe harbor, you have to begin construction on or before July 4th, 2026. And for FEOC, you have to begin construction on or before December 31, 2025. Okay, well, now we kind of have some tools available to parse through this. Let's say you're a nonprofit and you want to begin construction by December 31, 2025. That should sort of be our default game plan. Yeah, if you can't, aim for July 4th, 2026, for whatever reason, if you can't. But assuming your project is at or under 1.5 megawatts, you're probably going to utilize the 5% safe harbor. Figure out whether or not you're a cash basis or accrual basis. Cash basis is all about when the dollars transfer. Accrual basis is all about when the liability is accrued and recorded on your books. Actually, it's not when the dollars transfer, and those are different things. So make sure you kind of wrap your arms around which of those you are and which you have to be, accountable to. And then make sure you have a binding written contract. We touched on this a little bit before. Um, Having a binding written contract, that's actually a term of art, and there's a bunch of rules attached to what it means. But the important one I really want to emphasize is that it can't be an option to build a solar system. You can't sign a document in December that says, yeah, if you want to cancel in 2026, that's fine. And then you get out to 2026, and now you have the option if you want to build it. You have this toehold back to 2025 to get your beginning of construction. That's just not going to count. So you really cannot have a sort of cancellation clause unless there's an exception to the exception to the exception to the exception. So if you do have some sort of escape hatch in your contract to escape this contract, make sure that there's at least a 5% or more penalty. So that will be deemed, that will be respected to be a binding written contract, even though it's, it has this ability to cancel. Because that's basically saying, like, look, there's some teeth in here. You can't just willy-nilly cancel in 2026. It wasn't just giving you an option to purchase in 2026. You were serious. You really did intend to begin construction in 2025 because there's a penalty. There's a bad thing that happens, a payment you're going to have to make. So make sure you're paying very close attention to your contracts and how they're written.
Lee, can I
That,
ask a question
yeah,
there? I'm so sorry, but
no,
I
please.
got inspired by what you were saying. So, for example, we often see contracts come through where there's you can cancel within 5 to 7 days for any reason. And then sometimes we might see a cancellation for convenience. Are the two viewed the same way? And both would need to have like a minimum, basically penalty if they were going to remain in the contract.
Yeah, if you're trying to claim a beginning of construction date in 2025, get rid of it. And
Go.
if you do have to have something, then put in a penalty clause. Just it. These We're in a special time right now, Nicole, and the rules are a little bit different because we're trying to protect the integrity of the safe harbor. A year
Yes.
ago, if we were having this conversation, we'd be all over that strategy, and we would, want to, uh, protect the interests for the nonprofit and make sure that they, have some of these provisions. We've written some of these provisions into our contracts, so we're adapting that a little bit for the next couple months. But I expect once the need to claim the beginning of construction safe harbor has passed at some point in the future, like we'll revert back to some of these other contract language provisions that do involve termination for convenience clauses and other sorts of you know remedies and things in the contracts.
Perfect.
Um, so cash method's pretty simple. You just have to make sure the cash changes hands. Like your evidence is going to be your bank statement, your wire transfer, whatever that is. Accrual method, remember that's a little different because you have to have that economic performance uh, and the all events test and everything else we talked about. So you want to be very careful to structure milestones that have some kind of good or service that's going to meet the economic performance test by 12/31. So we're seeing things like, have your permit interconnection package submitted. because that's an easy one to kind of quantify and define. Whereas in the past, we might have said the milestone is when the permit is approved. We're adapting a little bit here and saying, yeah, we're going to say when it's submitted or
And
some
this would be under the 5% safe harbor,
under the
not,
5% safe
yeah,
harbor. Yeah. Yeah. I'm assuming like we're going down this sort of pathway for
yeah.
a typical nonprofit. You're probably doing 5% and you're probably accrual and you're probably going to need to prove that there's economic performance by the year end. So that means like having some good or service performed. And a permit is one way to do it. The other thing is equipment is another way to do it. The equipment does not have to be delivered on site. The equipment just needs to transfer title. So there's some other risks where, okay, you're transferring title, it's staying in someone else's warehouse. You got to make sure it's properly insured. You have chain of custody, you have serial numbers. It's your goods sitting in someone else's physical possession, so it has its own risks. But technically, that would count as delivery or economic performance because you transferred title, and so there's different ways to kind of meet this milestone or this requirement, but just be very mindful of this economic performance requirements. There are some exceptions. So there is this 3.5 month rule, which says that, okay, pay for it, and we reasonably expect it to be delivered within 3.5 months. And there's different tests about what constitutes reasonable expectation, but you probably want to document it. Like if for example, you've done this 10 times and they always deliver in the first 6 weeks, or if you have history, which you probably don't if you're a nonprofit with a particular vendor. We do because we've done hundreds of these projects and we're very comfortable in this space. But at least document something in your contract, like we expect this equipment to be delivered by April 15th. Put it in writing, because it turns out that, under review, it doesn't actually have to have happened by April 15th, but you had to have reasonably expected it to happen at the time. So again, go back to this model of don't play games with the IRS. Like, but if you're ordering some equipment and it's from a wholesaler and it's going to be delivered, in a couple weeks, like you may have a backup plan. I don't recommend relying on any of this stuff. I would rather see economic performance completed by 12/31. But if you're watching this video in the middle of December and you're like trying to figure out, is there still a pathway? You may be able to have a valid set of facts and circumstances that could be respected by sort of putting together a really good strategy to prove that you began construction in 2025 and you're following these rules. I would look at the 3.5 month rule carefully as one potential pathway to do that, and just make sure it's documented really well. So keys here: document, 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 everything based on facts and circumstances. So, in conclusion, start now. I mean, I think that's the theme you've been hearing over and over from us. If if you start construction between now and the end of the year, you're going to have until 12/31/29 to place in service. Uh, the FEOC rules, the material assistance rules in particular, are not going to apply. So if you can start construction before 12/31, you're in the best possible position. If you can't, and you start sometime between January 1st and July 4th of next year, well, you're still going to get that ITC, beginning of construction safe harbor, give you 4 years, which is great. Um, but the material assistance rules under FEOC are going to apply. So that's a whole nother kettle of fish. And, that's another webinar that you can watch and get up to speed on. But you're still better off than if you wait until after July 4th, 2026, because then you have to place in service by 12/31/2027. There's no special exception for hurricanes, floods, natural disasters. Like you have to place it in service, and the material assistance rules are going to apply, and those can be significant. I still think FEOC is the sleeper cell problem of 2026, and we'll talk about that more in 2026. But to the extent that you're able to safe harbor, that is a pathway that has been provided under the law and made available to you to, uh, back to, you know, start now. If you can start before 12/31, get your beginning of construction before 12/31/25, you're just in the best position. And so if you haven't heard this enough times, start now. That is your takeaway from today.
Perfect. Shall we talk about some solutions?
Let's do
Uh,
that.
Excellent. I mentioned earlier that we have solutions that solve two major challenges nonprofits face when they're going solar, how to pay for it, how to get it built and built properly. And we do this with our solar loan and our solar power agreement, or the SPA, which is a subscription model similar to a lease structure. So if you want to own your solar system, the Collective Sun Solar Loan, that might be the right fit for you. The loan features a payment holiday during construction, so there are no payments until the system is installed, no collateral requirement beyond the solar equipment itself, no personal guarantee required, no prepayment penalties, and it includes a variety of risk mitigating best practices to protect your nonprofit. We also provide some project management support and installer vetting. The loan also includes our direct pay tax filing service and post-installation performance verification. Say that 3 times fast. All right. And if your nonprofit is more aligned with an easy button approach, the SPA subscription model, our third-party ownership structure, where Collective Sun designs the solar system, chooses a vetted qualified installer, manages the construction of the solar system, owns the solar equipment, monitors the system's performance, is responsible for operations and maintenance, and provides a performance guarantee, then a subscription model like the SPA could be the way to go for your organization. In this scenario, Collective Sun Foundation, our nonprofit, owns the equipment and you own the energy generated by the solar system. So you may be asking yourself, like, how do you decide? So deciding which option you want to pursue, loan or SPA subscription, is a vital first step, one that may come down to your internal culture. It's important to have this conversation with your green team so you know which option you want to pursue. And if you're not sure how to start that conversation, you could start by asking, do we have in-house construction management expertise? Are we comfortable bearing construction risk? Are we comfortable bearing long-term ownership risks? How do we feel about navigating beginning of construction rules, safe harbor, FEOC rules? There really is no right or wrong answer here. It's all about figuring out what makes sense for your organization. A few bonus thoughts I'd add here: with both of these solutions, the Collective Sun Solar Loan and our subscription model, the SPA, your organization owns the energy generated by the solar system. Both also require you to insure the solar system. And if you're considering a rooftop installation, you will want to make sure your roof is in good condition and you're ready to receive a solar system. And now that we have also have some additional resources on the next slide, I invite everyone to check out our website for a variety of amazing resources at collectivesun.com. The links in the slides will be available in the webinar recap, which you'll receive within a few days. And without further ado, I think we better jump into the Q&A. What do you think, Lee? Are you ready?
Sounds good. And I know there's a lot of information that was presented. So if we run out of time for Q&A, we will be sure to answer every single question in our follow-up with the slides and with the list of all the questions and all the answers, just in case of, don't worry if we miss your question today. I know we only have a couple minutes left here.
All right. Let's see. Please elaborate on what cash basis versus accrual basis means for the 5% test.
So this gets into an accounting question, that there's two ways to keep your books. You can keep them on the cash basis or on the accrual basis. And this is kind of universal for all accounting and bookkeeping. This isn't really a solar question at all. And it's all about, are you recognizing all of your accounting based on when cash is trading hands, or when you're accruing a liability, or when you're accruing, well, let's without getting into too technical of an accounting conversation, I will say there's two different methods of keeping your books, and different organizations use different methods. And you really need to check with your internal CFO or your treasurer or your bookkeeper and ask, hey, are we keeping our books on cash basis or on accrual basis? Now, one other nuance here is that what matters is how the taxpayer keeps their books, how the taxpayer reports which can be different than how you keep your books. Now, generally speaking, those should always follow each other. You're going to have your books kept a certain way, and your tax should follow your books. That's generally how it happens, but there's always exceptions to that. And so you're going to want to check with your tax preparer and your internal finance folks and just ask the question, are we cash basis or are we accrual basis?
Perfect. Lee, would you do us a favor and clarify the importance of December 31st, 2025 and July 4th, 2026?
Sure. Great question. So there are two different safe harbors that you're going to want to map and keep track of. For FEOC purposes, you need to begin construction by 12/31/2025 in order to be exempt from the FEOC requirements. That's one safe harbor. And the other safe harbor is for ITC that if you begin construction by July 4th, 2026, then you are safe harboring for 4 more years the ITC eligibility itself. So they're two different things and they're two different dates. But logically speaking, if you meet the 12/31, you're going to safe harbor for both.
Perfect. Okay. Oh, there's a lot of questions on accrual and cash basis. All right. So, what then happens if you don't meet the deadline of July 4th safe harbor?
If you do not meet the deadline, then you will be subject to FEOC requirements, which whatever they are at that time, with whatever guidance we have at that time, and you will have to place your system in service by 12/31/2027, full stop. And
Right. You don't get the
that
fourth runway.
that's that's a problem. The further that you get into, end of 2026, beginning of 2027, that's going to cause some issues for the industry because not all projects can complete very quickly. This is a bigger deal for utility scale projects because they need years. But even for distributed generation projects like ours on this webinar, 6 months could turn into 9 months. You could have extraordinary issues that take you beyond a year. Like there's always outlier cases, and that creates a risk that if you place in service after 12/31/2027, you would no longer be eligible for the ITC. And so you could find some people, like as you get into 2027, like you get out, think about it, you get out to August, September 2027, like, yeah, you're just not going to place your system in service that quickly. So ITC is functionally no longer available sooner. It it, it kind of handicaps the ability to access that tax credit. And direct pay by extension is just a bolt on to ITC. If you don't have ITC, there's no direct pay.
Excellent. So just to clarify, it looks like a follow-up question, but if you start construction on or before July 3rd, 2026, then
July
you
4th.
begin construction July 4th, then you would have 4 years if you did meet the safe harbor.
Yes, and it goes back to that continuity safe harbor, and it's the end of the fourth year after construction, so it's 12/31, 4 years later.
Perfect. Let's see, I'm gonna circle back to this one. So we have another clarifying question on the cash method. So this question is stated, I'm just going to read it verbatim. So does the cash method mean 100% of the cost has to be paid by December 31st, 2025?
100% of the cost of the 5%. So it doesn't mean 100% of the project costs have to be paid. It means you got to meet your 5% of total project costs as determined at the end of the project. That's why we say to use 7 and 9, maybe 12, but those costs would have to be dispersed before 12/31 under the cash method of
Right.
accounting.
I think it seems these accounting methods, use CPAs, Lee Barkin. I just don't know. It's so complicated.
Yeah,
Uh, but it seems like it's all coming back to the way the taxpayer, the nonprofit in this case, is the taxpayer, the way they keep their books. Fair.
correct.
Okay.
And I should add, just to put a fine line on that, it's not how they keep their books generally translates to how they keep their tax, because tax and books can be different. So it's technically it's the tax uh, portion that has to be determined as cash or accrual, but it usually follows books. So that's why I'm saying you can kind of use it as a proxy, but there may be some exceptions.
So here's a great one. So how does the idea of taking a 5 to 10% deposit coexist with the CSLB's rule of 10% or $1,000, whichever is less for deposits?
Yeah, so great question. Deposits under the cash basis, it's just money out the door, check. But under the accrual basis, you have this economic performance, and a deposit does not count. You have not received a good or service. The work has not been performed. There hasn't been performance of that work. So I would try, instead of just taking a 10% deposit, I would try to have a milestone that had performance of some good or service that you can demonstrate occurred before 12/31. That's the safest, way to do it. And there's still time. I mean, again, we're only at September 4th. There's still time to effectuate that. Just describe or define your milestone in such a way that you meet the economic performance test uh, to have performance of that good or service.
Okay.
Performance or delivery of that good or service.
All right. I think we can do one more. So if our church installs one solar array that feeds two banks of batteries with two inverters, sorry, is that integrated?
So there is a whole separate conversation around functional integration and functional interdependence with batteries. And all of these rules kind of changed. If you follow how the code has evolved, there's now energy storage technology, which is kind of standalone under Section 48. So the problem with, because I could answer this question with our famous, what's the answer to every question?
It
It
depends.
depends. Okay, so here's why it depends. If you remove the battery, does it still function? There are certain circumstances where the system might still function, and there are certain circumstances where it might not function. So, generally speaking, though, the way that these trends are moving is that you probably have two separate, an energy facility and uh, a qualified facility and energy property. You probably have two different ITCs. Again, depending on where the electron's going and how it's actually engineered. Um, you probably have two different ITCs, and that is potentially problematic if you're claiming beginning of construction, for one or the other. So you have to pay particularly close attention to that, unless you can demonstrate that they're functionally interdependent, and then you have one ITC, and then you're going to get a toehold for one of them. But this is hotly debated in the space right now, and it is ultra facts and circumstance based. So I would look at every single case independently and try to perform that analysis about whether or not it meets that functional interdependence test set of rules, and whether or not, which is its own kind of independent analysis to determine, do I have one ITC here or do I have two ITCs here?
All right. On that note, a big thank you to everybody for joining us today. It is that time. The webinar recap is going to go out within a few days. Rosanna is amazing. The team that supports her is amazing. So you never know, cross your fingers, but I would just say, give it a couple days. That'll include a recording of today's presentation along with the Q&A transcript. So any question that was answered live or that we didn't have time to answer live, you'll find all those answers in the Q&A transcript. If you have more questions, please feel free to reach out through our contact us form. I believe Rosanna threw that link into the chat. And if you missed the call to action, it's start now. Start now. Thank you, everybody.